Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I want to talk about the pros, the cons, and what you should consider if you're looking at paying your mortgage down early. Now, maybe you already have a home and you've got to a point now where you're thinking, I'd like to be mortgage free. But you're also thinking, maybe I want to invest some money and grow the pot of cash that I've got that way as well. Well, in this video, I'm going to look at all the things that you should consider, what you should do first, what steps you need to take, and maybe this will help you decide what's right for you. Now, with all of this financial advice, you should always go and speak to a qualified accountant or a mortgage broker or someone that really can look at your personal circumstances. I will share what I would do in this video, but always make sure that you get very professional advice as well. Now, if you're new around here and you didn't do already, do make sure you subscribe to the channel over there and hit that bell notification. We're on the way to 39,000 subscribers now, which is crazy. Every day we've got new content on investing, the property news, interest rates, house prices, and much, much more. So that's a reason to subscribe. And let's get some views on this video by smashing like, tickling like, doing something to that like button. That really helps with the YouTube algorithm and helps the channel grow. So thanks to everyone that does that. So, what should you be looking at first? Well, the first thing that you should be looking at is your personal debts. These are very important to consider. And so why would we look at that? Well, the average mortgage rate at the moment is around 5%. But some of you watching this that want to clear your mortgage have mortgage interest rates of 1%, 1.5%, 2%. But your debt might be considerably more. So first, you need to look at, do you have any credit card debt? If you have credit card debt or store cards, they could easily have around a 30% interest rate. So you must look at clearing down your credit card debt first, because that is really sucking your net worth out of your pocket very, very fast. Next, you should be looking at any car leases or car loans that you've got and looking to clear those down early, way before you consider anything around making your mortgage reduced even faster. And that's because the mortgage debt, the interest rate is so much lower. So get rid of the high interest rates first. You should also consider, could you get a better savings rate than the mortgage rate that you're on at the moment? So let's just say you've got 10 grand, 100 grand, whatever amount it is that you've got. There are accounts at the moment where you can still get around a 4% interest rate. So what you should consider here is, let's just say for argument's sake, your mortgage rate is 2%, but the bank will give you 4% as a savings rate, which they can still do while rates are still fairly high. That might change in the future. I would consider in that scenario keeping the money in the bank. In fact, I would invest it, but if you want to save it, look at a higher rate of interest. If it's higher than the mortgage rate, that's another option to consider. That's important. How can you save interest with the mortgage? Well, one thing that you can do without any penalties, and this is a thing to consider, is to overpay the mortgage by 10% a year. So when you go and get your mortgage, nearly every lender will let you overpay the mortgage by 10% a year with no penalties. So that's a good starting point. Rather than paying all of the mortgage off, which will incur penalties, which we'll talk about shortly, you should consider overpaying the mortgage by 10% a year to start with. That is a great amount that will get that mortgage reduced very, very quickly. The next year, let's just say for argument's sake, you had a 100k mortgage, you pay 10% off, now you're only paying interest the next year on £90,000. So the payments, even if you keep them the same at a monthly level, then are going to knock off more of the balance in that second year as well. So look at paying potentially 10% off each and every year if you want to. You've got to consider the penalties. This is where you need to have a look and grab that contract out that you signed when you did the mortgage. I've just done one this week, and in that I've got a 5% penalty. 5% penalty. So what does that mean? That means that if I want to clear the mortgage down right now, because that deal I got for 4.5%, I think the interest rate was on that one. So I've got a 4.5% interest rate, which is higher than I would have had for a long time. We've had really low interest rates for many, many years. Let's just say we go into a massive recession and the interest rates go back down to zero again. In that scenario, I'm going to be a bit frustrated sitting at that 4.5%. But if I want to pay that mortgage off, because the bank wants to make their profit on me, they will charge me 5% of what I've borrowed. So if I borrow 100 grand, it's going to cost me 5 grand just to pay that debt off. So it wouldn't be worth it in that scenario. Now, the second year, it goes to 4%, then it goes to 3%, then 2%. Then last year is 1%. So have a look at the penalties you're going to get if you pay your mortgage off. That's very important as well. Now, a thing to consider here is if you do pay off all of this and you do pay off your mortgage, then probably your pension's going to be smaller, because the money that you use to pay down your mortgage could have gone into your pension. So you've got to consider that you would have a smaller pension pot because of that, and that could mean that you'll get less each month when you actually need that pension pot. So that is very, very important as well. So what's an alternative? What else could you do here? Well, what I would do in my case is I would buy a second property, and I might just buy it as a boring vanilla buy-to-let property. So if you had 100 grand, I'll talk in easy, simple numbers here. You can use that as a 25% deposit on a property, meaning you could spend 400 grand on a property. Now, there are going to be stamp duty on top of that, which has gone up a lot, but we'll just forget about that just to make this example easy. So if you had 100k, you could spend buy a 400k buy-to-let property. Obviously, there is going to be fees on top of that, so you've got to work that out. And those fees could be quite considerable. It could be like 40 grand, 50 grand there with the stamp duty and all these other things on top. So take that into account. But let's just use simple round numbers here. So you've got 100k, you put it in, you get a buy-to-let property. You're then going to get rent every single month. So this is like a pension to you at that stage. Now, you're going to have a mortgage that you've got to pay each month, which will be on interest only. But if you buy in the right area, and if you buy a property that you can add value to as well, that's important here, that you can add value. Ugly houses win all the time on this one. In that scenario, you would then be able to, in that scenario, in about 10 years, that property would be worth around 800k. Now, you would have had a 300k mortgage on this, which would be interest only. And that's still going to be there. You've got your 100k that you put in as a deposit, and you've made 400k in equity in this scenario. So what you're actually going to have in this property here is 500k now in equity. Plus you'll have got your rent every single month as well. Now the rent will be your cash flow to manage things like repairing your boiler. You're not going to make lots of money and profit off your rent, but the capital appreciation is where you've really, really done very well here. And in that scenario, you've now made a lot of equity. You've got your original property still, which will have gone up in value as well, I'm certain, if you bought in the right area. And this is how you will now have 2 pots of cash growing and improving your net worth. So would I pay the mortgage down? If it was some of my friends that like certainty, I'd say yes. I'd say 100% yes. If you don't like a risk and you want certainty, then look at paying your mortgage down. But consider the penalties. Consider doing it at 10% a year, to avoid those penalties. And then you've still got that emergency fund if you still need it. But if you like a little bit more of a risk, and it's not really a massive risk, look at doing some investment properties, because in that scenario, you're going to get a regular income like a pension. You're going to get capital appreciation, and you would always do a property that you can add value. So look for an ugly house where you can replace the bathroom and make it nicer. Don't look at a new build property. That won't work. Now, if you want to make some money in a property downturn, I've got a free ebook that I want to link to below. So do grab that copy of the free ebook. It'll talk you how to buy auctions. It will teach you how to add value to property. It will teach you a strategy called buy, refurbish, refinance, rent, and much, much more. Do check that out. Do also smash the like button on this video and check out all the other content as well on the channel, including this video right here.